Welcome to the BF Anderson Technical Report for October the 17th. A lot going on. Things are improving. We're seeing here on the NASDAQ that we're now seeing a move by the index back above the two moving averages. Lower moving average is turned up. However, we are still moving somewhat sideways, but it does look like the correction that we experienced here recently could be in the final stages. Now, really, one of the most important indicators that we use, and one thing I want to mention is that the indicators that we're looking at today and we look at every week, these are nothing more than ways for us to understand what's going on with the markets. Well, are we in a healthy market, unhealthy market, so forth. Some of these indicators we use just as to observe, and then some of these indicators we actually use in our work. Well, this is one we actually use in our work. It's a very good indicator. This is the 35-week moving average. Now you can see that a couple of weeks ago we broke down below that 35-week moving average, just like we did back here. However, we held. We did not close below it for the week, and it held. So that's a very big positive, very positive. Now, a new indicator that we're observing that I think is important is I'm calling it a rotation graph, because what we've been going through for really since last year, since September of 18, we've been going through a rotation of leadership. Now, what I've got here is a ratio. This is the NASDAQ composite compared to consumer staples. So in other words, we're comparing growth stocks, technology stocks, retail stocks, healthcare stocks. We're comparing those stocks to what we would call toothpaste stocks, toilet paper stocks, soft drink stocks. So what tends to happen is when you go through a rotation, the market goes into a correction, the leadership of the prior move runs out of steam, then the defensive stocks take over, meaning the consumer staples, and we see a divergence. Now, let's look at this graph for a minute. Now, we have some rules on this, and I want to go over the rules. I take the graph back to 2013. When the line is going up, it's telling you that the technology stocks, healthcare stocks, the NASDAQ is outperforming the toothpaste stocks. So you get this kind of rally here. Now, what's important for most investors to understand is that these two groups tend to counteract each other. Growth stocks is a growth strategy. Toilet paper stocks and toothpaste stocks would be more of a value strategy. So some people like the value strategy, some people like the growth strategy. I think you really have to determine which strategy makes the most sense. In other words, everybody has a mind that thinks differently. Your brain says, okay, I understand growth. Therefore, when you hit difficult periods for growth, because you understand it, you're going to stick with it. And I'm telling you, 90% of the equation here is staying power, being able to stick with a strategy. So if every time the strategy goes out of favor, you then abandon that strategy and go to another strategy, well, what ends up happening is the strategy that you've abandoned starts to outperform, and the new strategy that you have adopted starts to underperform. So let's go back. Here was 2013, which was a really good year for us, being that we're in growth stocks. You can see how the line went up. But then starting in 14, 15, and going into the election, growth stocks just really underperformed right here at the beginning of 16, and then the election, and the growth stocks broke out and took off and have been outperforming here most of 17, and then right up till about September of 18, actually more like May, June of 18, the growth stocks peaked out, and then the toilet paper stocks took over, and you can see here that the growth stocks started to underperform. So here's the rule. The rule is that you have a 10-week moving average, which is this is the 40-week, which would be the red line. So you have a 10-week and a 40-week. Now the rule is that if the ratio gets back above the lower moving average, which it's doing now, and then the lower moving average turns up, that is a very positive sign, because you can see what happened back here in 16 after the election. You got down below both of the moving averages, then it turned up, and then off to the races. Then we had the same thing happen back here in December of last year when the market bottomed. Then we turned up, growth stocks started to outperform. So it's not just rotation that's going on. It's basically another way to determine, are we in a healthy market or an unhealthy market? Well, it looks like to me that this indicator is starting to improve. You can see here that it looks like it's put in somewhat of a double bottom here, and that it's starting to turn up. Now it put in a, pretty much a double bottom here as well. So the main thing is, and then down here at the bottom of the graph, it's kind of confusing, but I wanted to make the point this way. I'm comparing Amazon to Procter & Gamble. So we have growth versus soap. And you can see here that starting in September of last year, Amazon was underperforming Procter & Gamble. Well, it's starting to you can start to see the turn up that we're talking about. So what we would really like to see happen here is that this ratio get back above both moving average and get into an uptrend, something like this here, and I really think that's going to be a positive sign. Now on the advanced decline line, again, we just observe advanced decline line. We don't really use it that much in our work, but it has somewhat flattened out, but starting to turn back up again, so that's a positive. Now on the number of new lows, yesterday we had 22. We kind of got a little bit elevated here at the beginning of October. However, things have somewhat settled down. Now on this graph here, I went ahead and modified this graph. This is our long-term graph, what we call the 2010. This is comparing a 10-month moving average to a 20-month moving average. What we're looking for are death crosses or golden crosses. And what I did here is I just shortened the time span. Instead of going back, say, 20, 30 years, I just go back to 2009, and that way you can see the graph a lot clearer. And you can see also that the S&P is getting very close to making a new high. The upper moving average has turned up. We've got a good, healthy looking pattern here. So long term, things really look good. Now on this graph, I've also modified this graph as well, because sentiment is important. Most people don't want to get involved in the stock market unless it's apparent, unless it's obvious. And so what happens is that you get into these periods of extreme fear and extreme greed. The best time to be adding money to your portfolio or building your portfolio is in times of extreme fear. And I know that's hard to understand, but it's true. And so what I've got here at the bottom, I've got here the American Association of Individual Investors bullish survey, and then they also do the number of bears. So they have a survey that they do where they ask people on a weekly basis, are you bullish or are you bearish? And so what you do is you take the bulls minus the bears, and you end up with a negative 23.7. And so we've learned over the years, and like, for example, I've got the S&P down here. You can see that the low that was made last year in 18, you had a reading of about a negative 25 on the bulls minus bear reading, and right now you can see where we are. So pessimism is very high, but this is very bullish. That's a positive. Now on the other long-term graph using the S&P, we're looking at a 200-week moving average. What's interesting about this particular indicator is you get a pullback close to the moving average, you rally to new highs. And so what happened here, we pulled back close to the moving average last year. We have since rallied to new highs, pulled back, and are rallying again. However, what's interesting is that you're making higher lows and you're making higher highs. This market looks like it wants to make a new high. Now on the global Dow, we're still stuck in the mud. It's a good long-term looking graph, but here recently, starting in the beginning of 2018, just things really went dead. Pretty much a big correction in the global stocks, pretty much moving sideways. Now on the value line composite, I went ahead and changed this chart as well so that it's easier to see. You can see here resistance, resistance, resistance. The index is having trouble getting through this particular area, which is around 500, 520. We then pulled back here right going into the election. Then we pulled up back last year. We are just like the global Dow. We're making higher lows. However, we're not making a higher high here. I think this is the most important index that you can keep an eye on because it's equally weighted and it's a 1,700 stock index with somewhat of an emphasis on growth stocks. Now, on the top 5, we're seeing some changes there. Again, we're seeing rotation. This is KLA Corp, which is a semiconductor equipment maker. In other words, they make equipment for the semiconductor industry. You know, it's been interesting with this rotation when it comes to technology. You know, in the prior cycle, when we peaked last year, it was primarily being led by enterprise software stocks. Now we're seeing a leading of not semiconductor stocks, but the companies that make semiconductors. Now, what this would mean to me is that the market is telling you that there's going to be a dynamic change in the semiconductor industry, meaning there's going to be a lot of new, artificial intelligence, autonomous automobiles, etc. That these new chips that are being designed will come forward. So you're going to need manufacturing equipment to make the new chips. This is Medison's company. Now, we own this stock, and I have to, throw in the fact that this is a very, very speculative situation. This company has no revenues. They have no earnings. However, they've got a blockbuster drug that is up for approval with the Food and Drug Administration this quarter. They're going to be making a presentation to the American Heart Association in November. However, the stock did break out and make a new high yesterday on really a higher volume, not above average volume, but higher volume. You can see here that this is where they had a 3,600 patient study that was quite successful. And that study got announced right in here. And so you can see we've got a really nice ascending flag formation. But I do want to emphasize this is venture capital and very speculative. This is Pod or Insulet, again, another medical stock that has a breakthrough in the treatment of diabetes. This is Ring Central. Now, this is another stock that we have taken a position in. They just signed a deal with a company called Avaya. They're going to have access to Avaya's customers, which is about 100 million customers. The company currently has 2 million customers. So when the CEO was asked on the day of that contract that it was announced if this was a good deal, and he said it wasn't a good deal, it was a great deal. So the stock broke out, gapped up. Yesterday did pull back somewhat, but did hold the gap. So Ring Central looks interesting. We use the product here at BF Anderson. Target continues to look good. All the retail stocks like Walmart, Home Depot, Target, Costco, all these stocks are looking good, and I think it has a lot to do with the fact that unemployment is at record 50-year lows. So if you have any questions, please give me a call. Thank you very much.